Es un placer saludar a Jay Pelosky, es el fundador de TPW Advisory. Jay, thank you so much for joining us in Negocios Televisión.
Thank you, Marta. Nice to see you again.
Jay, we are talking a lot about inflation is running high, and central banks say that this period of inflation is unusual and temporary, not a sign of a chronic situation. Is this true, or should be worried?
I'm in the kind of transitory camp as well, Martha. I think inflation has kind of been higher than expected for longer than expected. I think part of that is due to some of the supply chain concerns that have been visible over the last few months, as well as some of the energy shortfalls that have occurred in different parts of the world. But I think importantly, both of those are seasonal and are likely to become much less important in the next couple months. Certainly energy-related winter, concerns about the winter colder temperatures in the U.S. and Europe and China. And likewise, the supply chain concerns, a lot had to do with trying to get goods to the stores for holiday season shopping. And so if you look, currently prices on the energy front have already come down pretty significantly, and the supply chain concerns are already ebbing. You can tell that from the price of shipping containers from Asia to the U.S. have fallen by about 30%. And even in some of the recent data, you've seen the delivery times start to come lower, which suggests that the supply chain concerns are starting to become less driven, less worrisome. So I kind of remain in the transitory camp. I think we may have 1 or 2 more months of higher than expected inflation. But I think for the most part, the markets, particularly in the fixed income markets in the U.S. and in Europe, have already priced in actually more central bank response than I think is likely.
And while talking about central banks, Federal Reserve will start its tapering later this month. And meanwhile, we are expecting to know who will be the next Fed chair. Biden is still deciding whether to reappoint Jerome Powell or replace him. What are the expectations?
No, I think you're exactly right, Marta. I was just talking with some folks this morning about this very topic. And it is surprising that the president has not already made a decision, which makes one wonder whether Jerome Powell will be reappointed. I don't think that the market reaction is going to be very significant if he is not reappointed, because Lael Brainerd, who is the likely choice if it's not Mr. Powell, is someone who's very well known and well respected in the financial markets, and is unlikely to lead to any kind of significant policy shift within the Fed. I think, as you pointed out, tapering is underway. The Fed gave themselves a chance to reassess the speed of tapering in their December meeting, which is coming up in several weeks. And that's where we'll probably see whether the Fed is starting to get worried if inflation is more than transitory. If they're worried that inflation is going to be here to stay for a while, then I think we can expect to see the tapering pace pick up, which gives them more time to assess things as we move through 2022. Right now, markets are pricing in at least 2 rate hikes by the Fed, maybe even 3 rate hikes by the Fed in 2022. I think that's too aggressive. I'm thinking much more 1 hike, maybe 2, but I think certainly 3 is way outside the realms of the likelihood.
And Jay, let's have a look into European markets. Which are the main forecasts and concerns as we are closing this 2021?
Well, I think Europe has had a great year from a financial market perspective. Certainly the ETFs here in the U.S. that represent Europe have done very well. Many of them are up 20% or so. Europe, I think, has generated great earnings growth. It's very impressive to note that in the third quarter, the earnings season just kind of completed, European earnings averaged about 40 to 45% earnings growth year over year. In top line, so sales or revenue growth was around 12 to 14% up year on year. So those are very strong numbers, and it reinforces the fact that Europe, the companies have been able to continue to do business even amidst all the various lockdowns as a result of COVID. My view is that 2022 will be a year of clarity, a year of kind of relative normality, and so a lot of the worries like COVID, like climate, they'll still be there, but they're going to be less, they're going to be more in the background, less right in front of us. And then the supply chain and energy concerns are going to kind of dissipate or go away. And so that allows markets to focus on things like GDP growth, inflation, earnings. And there, I think Europe continues to look attractive. We're overweight European equities. We really like European banks. Europe stocks are cheap. They're really not very well owned by international investors. And I think Europe next year has a chance to grow faster than the United States, real growth of about 4% or above. And the currency has weakened significantly, which should allow European companies to be quite competitive internationally. So I'm quite constructive on the European equity outlook for next year.
And from your point of view, which are the main threats for the economic expansion?
Well, I think one of the concerns would clearly be if inflation does kind of stay well above expectations and forces central banks to act more aggressively. That would clearly be an impediment for the equity markets. I guess another one would be in the case of Europe, if the currency really continues to weaken sharply, raising concerns about inflation and creating, again, uncertainty in the minds of investors. I think otherwise, the European situation looks pretty bright. You have the next generation stimulus disbursements. I know Spain, Italy, other countries are going to receive significant amounts of money in the next couple of years to kind of rejigger their economies and prepare for climate change. I think all that's very constructive for Europe. And in addition, I think Europe continues to integrate, and there's growing talk of a banking union and a capital markets union. I think there's a growing understanding for Europe that it needs to continue and accelerate the integration process if it's in order to really compete successfully with Asia and with the Americas. And we see that with the issues around electric vehicles and battery production in Europe. We see that around the desire to have semiconductor production in Europe. And we see that with growing talk, even in Germany, of the need for a banking union and a capital markets union. If those things are to come to pass in the next couple of years, I think the outlook for European financial assets would be very bright.
And considering the current market scenario, where do you see investment opportunities for 2022?
Sorry about that. Sorry, Martha. The opportunities for 2022, I think, continue to be primarily outside of the United States. We spoke about Europe. I'm also quite constructive on Japan. Japan is going to announce a major fiscal stimulus in the next couple of days. It will probably be the biggest stimulus package for 2022 of any of the major economies. That's quite constructive. Their currency has also been cheap. And Japan is a well-known cyclical market. The other market that I'm pretty keen on, that I don't think many people are, is China. China has had a very challenging year with all the government edicts, with the concerns around the real estate business there, with issues around energy supply, et cetera. And so the Chinese markets have been big underperformers. Likewise, Japan has been a big underperformer. So as we go into 2022, I think investors should look at the laggards, which I believe will become leaders. So for next year, I think China is going to have a glide path year, right? You have the big People's Party Congress a year from now, where President Xi is going to most likely get his third term. I think in the run-up to that, China is going to be a very smooth operating economy next year. They have all the fiscal and monetary stimulus necessary to sustain growth of around 5%. The assets have been really beaten down, both equity and debt. And so in our model portfolios at TPW Advisory, we have significant overweights both to the Chinese equity markets as well as the debt markets. And in the debt, we own both government debt as well as corporate debt. Right now, you can buy Asian high yield debt yielding 10% in US dollars with a duration of less than 2 years. I think it's very, very compelling.
Jay Pelosky, yes, thank you so much for your time and for having us a few minutes in Negocios Televisión.
Thank you, Marta, and I hope to see you again soon.